Staking promises effortless rewards, but behind the advertised yields, millions lose out every year to hidden dilution and sudden price shocks. In 2023, a single token unlock wiped 15% from Aptos in just 24 hours, while Cosmos stakers have seen ownership halved by supply inflation. Most never realize how much is eroded before they even count their gains. What are the real costs everyone overlooks? Token supply growth is built into the foundation of most proof-of-stake networks. Protocols like Cosmos launched with an annual issuance rate close to 20%, promising high headline yields to early stakers. Over time, this rate decays. By 2024, Cosmos supply growth dropped to about 7%, but even as the inflation rate tapers, the impact on long-term holders is profound. A retail staker who began with 1% of total supply in 2020 and simply restaked rewards would see their share cut nearly in half within 5 years, even before accounting for price swings or validator fees. The math is mechanical. When new tokens are minted at a rate outpacing organic demand, every participant's slice of the pie shrinks. High issuance regimes front-load rewards, but ownership dilution accumulates year after year. Decaying schedules, like Solana's move from 8% to 4% over 3 years, slow the erosion but never fully eliminate it. The baseline risk is clear. Before any unlocks or market shocks, programmed emissions alone can erode a staker's real position by 30 to 50% over a typical vesting cycle. Unlock schedules add a new layer of risk, often overlooked until it is too late. When tokens move from lock to liquid, the way they enter the market, cliff versus linear vesting, shapes the size and timing of sell pressure. In a cliff event, a large block of tokens becomes tradable at once. The Aptos unlock in September 2023 released 12% of its circulating supply in a single day. Roughly a quarter of those newly unlocked tokens were sold immediately, accounting for about $150 million in volume, almost matching the entire 24-hour trading activity. The result was swift, a price drop of nearly 15% as order books struggled to absorb the flood. Linear vesting, by contrast, spreads selling over time. But even then, liquidity can thin out during slow periods, amplifying price swings. For retail stakers, these events can wipe out months of staking gains in hours, especially when order book depth fails to cushion the impact. Every staking reward passes through a gauntlet of validator costs before reaching the end user. Operators set commission rates, typically 5 to 15% deducted from all rewards before distribution. Beyond that, running a validator node incurs steady expenses. Cloud servers, bandwidth, security monitoring, and redundancy push monthly costs anywhere from $100 to $500 per node. For solo operators, these fixed costs demand a much larger stake just to break even. On Ethereum, a single validator often needs at least 50 to 100 Ether. At current rates, for delegators, the result is a persistent yield drag. Headline rewards are trimmed by both commission and operational overhead, shrinking the net return before any market risk is factored in. Downtime and slashing penalties add another layer of risk that rarely shows up in staking calculators. Even with median annual slashing rates below 1%, the consequences can be severe for those caught in rare but disruptive events. Solana's September 2021 network outage offers a cautionary case. While no slashing was triggered during the 17-hour halt, the episode underscored how validator accountability can suddenly come into focus. In Solana's design, a validator found at fault during a tail event can lose up to the entire staked amount. For retail stakers, this means a single misstep by a chosen validator could erase months or even years of compounding. Such tail risks may be infrequent, but their impact is anything but trivial, and they remain largely invisible until triggered. Most retail stakers rely on headline annual percentage rates, assuming the posted yield reflects their real return. But these figures ignore dilution from inflation, volatility driven by token unlocks, and validator risk. Surveys show the majority never adjust for supply growth or model the timing of token unlocks, even though both can wipe out expected gains. Few check validator reliability beyond commission rates, underestimating the impact of downtime or slashing. These blind spots, chasing nominal yields, overlooking unlock windows and trusting validators without due diligence, compounding quietly, erode the value of staking far more than most realize. Without rigorous modeling, compounding benefits are often just an illusion. Unstaking periods and transaction costs set hard limits on how much compounding is possible, especially for smaller accounts. On Ethereum, unstaking can take up to 7 days, while Cosmos requires a full 21 days before tokens become liquid again. Each restake triggers gas fees, often $15 to $50 per transaction. When these frictions are factored into scenario modeling, the impact is clear. In a conservative case, with 8% nominal annual percentage rate, 3% supply growth, 5% commission, and moderate unlock sell-through, staking remains accretive over any horizon. The median case, with 10% annual percentage rate, 7% supply growth, 10% commission, and higher unlock sales, only breaks even after 2 to 3 years. In stress scenarios, with 12% annual percentage rate, 15% supply growth, 15% commission, and 75% unlock sell-through, real returns turn negative, and staking erodes value over 5 years or more. The true return from staking comes down to a single calculation. Real yield equals 1 plus the nominal annual percentage rate, divided by 1 plus annual supply growth minus 1. With a 10% nominal annual percentage rate and 5% supply growth, the real yield is about 4.76%. To replicate this, stakers need just 3 inputs: the posted annual percentage rate, the protocol's annual supply growth, and validator commission rates. All figures are sourced directly from protocol dashboards and on-chain explorers. Staking isn't set and forget. It is a moving target. As protocols issue new tokens daily, real returns shrink in real time. In crypto, yield is never as simple as it seems.